I want to be clear, I do not respect the SEC.
We made the decision in the morning to limit the buying of about 13 securities on our platform. So we're really in unprecedented times. In order to protect the firm, we had to limit buying.
That markets are efficient because of active managers setting the prices of securities. Firms like Citadel, we're all running large teams of people that are engaged in fundamental research, trying to drive the value of companies towards where we think they should be valued.
Sam Bankman-Fried and FTX, he's been charged by US courts and the SEC with money laundering, conspiracy to commit wire fraud, and securities fraud for the collapse of FTX. The former chairman of NASDAQ, Bernie Madoff, built the largest Ponzi scheme in history. Over 4 decades, he faked records of annual gains to investors who thought he was investing their funds, when in fact, he was just using new investor capital to pay off older investors.
But the synthetic shorting and naked shorting, which is illegal, market maker can execute naked shorts insofar as they're facilitating a trade. The regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts. And I think they're going to uncover that there were some issues there. But the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing this.
Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources.
I basically would like to ask the SEC why they didn't act on the morning of January 28th, because I was so scared. I can't tell you how scared I was. I was so scared. I can't tell you how scared I was.
Well, Thomas, what were you scared about? What does failure look like? You said we came close to breaking. What were you scared of?
I was scared of a domino bankruptcy. I tell you, the rules require the long brokers to go into the market and buy the shares at whatever price. So that drove the shares up to $480, and then suddenly it didn't go further, but it could have gone further.
So buying and selling those 200 shares would make the market maker $1. But as millions of shares are traded, the profits from the spread add up. In 2020, these brokerages collected almost $2.6 billion in payments for stock and option orders.
These brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers.
Business has always been done like this on Wall Street for over 100 years.
Our orders compete against each other to get the best prices. But if the order instead is routed to a wholesaler that has agreed to pay for it, the order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
As you mentioned about commission or zero commission does not mean it's free. It does have some cost inside. Some brokers have payment for order flow.
Disclosure alone, by enhancing the disclosure around payment for order flow, really will address it. United Kingdom, Canada, Australia, all have banned payment for order flow. I know we have different markets, different systems. We even have letters that we've gotten over the years, dating back over the last 20 years, articulating why it's not good for our system. So I really ask staff to consider that, but also to consider it only in the context of the entire market structure.
On January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities imposed temporary trading restrictions on certain securities. Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements.
The decision to restrict trading really was internal to Robinhood. We did not have discussions about that.
Like GameStop, AMC, all these meme stocks have brought naked short selling really to the forefront of the market's interest. This is something that's going on for a very long time in a small cap market and is very much a problem.
Has your husband ever made a stock purchase or sale based on information you've received from you?
No, absolutely not. Okay, thank you.
Those are fully collateralized tokens.
That markets are efficient because of active managers setting the prices of securities.
The order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.